Well, good morning and welcome to this webinar. My name is Jeff Rathke. I'm the president of the American Institute for Contemporary German Studies at Johns Hopkins University. And we're really delighted to have you with us today for what is the penultimate seminar in our series of events profiling the research and writings of the 2021 cohort of DAAD AICGS research fellows. This has been one of the most intensive periods in my experience, and I think in our recent history, with 6 visiting fellows in the span of just a couple of months. And so I'm really delighted that today we get to hear the results of research by Michael Schwan. I will hand things over to my colleague, Peter Rashish, Senior Fellow and Director of our Geoeconomics program, in just a minute. I look forward to hearing the reflections on the comparative political economy of finance during the COVID-19 pandemic and how some of the really unprecedented policy measures that have been implemented in just the last 18 months or so, what emerging findings Michael has to present and what lessons we can draw from it. So Peter, I hand the floor over to you and you can get us going.
Thank you, Jeff, and welcome all of you to this event today. Michael Schwan, our speaker today, as Jeff mentioned, is a DAAD AICGS research fellow. He arrived in Washington in October, and he's going to be departing a little later this month. He is a postdoctoral researcher at the University of Cologne in Germany, where he's part of the Cologne Center for Comparative Politics. He studied political science, sociology, economics, and economic geography in Marburg, Lucerne, and Cologne, and holds a PhD from the University of Cologne's Faculty of Management, Economics, and Social Sciences. He has spent time in the United States before, when he did a research stay at Boston University's Frederick Pardee School of Global Studies. And as a political economist, he is focused on deciphering socioeconomic foundations and ramifications of financial markets, corporate governance structures, as well as national growth models. Some of his previous projects have dealt with sovereign debt management, public banking, and regional effects of financial market integration in Europe. And currently he's working on new forms of institutional ownership, corporate networks, and political economic reactions to COVID-19. So Michael, let me hand over the floor to you for your remarks. After you're done, I'll look forward to having a short exchange with you, and then we'll open it up to questions from all of you who are viewing today. And if you'd like to ask a question, please use the Q&A function and try to remember to put your question in that form. So thanks, and over to you, Michael.
Thank you so much, Peter. Thanks, Jeff, as well. And let me start by just saying that I'm so grateful and thankful for being here, and thanks to the generous funding provided by both the AICGS and the DAAD from Germany, True Transatlantic Cooperation. And thanks to all the staff involved, especially Susanne Dieper, for being so helpful and for just letting me do what I'm here to do, which is doing research and a joint research project, transatlantic research project, out of which some of the previous or preliminary findings that have come out of this are going to be presented by me today. Let me also say I'm very happy to have my colleague and friend here on my side to the left, Mark Cassell. Mark is part of this larger project, and he's a professor of political science at Kent State and also runs the DC program of Kent State's department. And yeah, he's also an expert in public banking and public administration, which it was sort of natural that someday our paths would cross. And we have had so far really tremendous, productive working relationship and just a great colleague. And he's part of this project. So let me start by sharing my screen and then we're good to go. All right, just hold on one more second. Okay. So as you can see here, the title, I tweaked it a little bit. The title is "Who Cares?" I mean, who cares is a phrase that we hear quite often when we talk about politics. As spelled in capital letters, it is the acronym of one of the largest, if not in fact the largest, economic relief bill that the United States, and with this, of course, also the developed world has seen following a crisis. And the subtitle indicates that we are interested in bank types, inclusivity, and lending patterns during part of the CARES Act's payroll protection, paycheck protection program, or short PPP. And together with Mark, who we just met, we have also on board Mark Schneiberg, who is a professor of sociology at Reed College in Oregon, and he sends his regards. All right, so let me get straight to it. Just first, a little bit of a background to the program. So as I said, the PPP is part of the CARES Act, which is short for the Coronavirus Aid, Relief, and Economic Security Act, the largest stimulus package in US history, amounting to more than $2 trillion, $2.2 trillion, or roughly an equivalent of 10% of the nation's GDP, the economy's GDP back then, in early 2020, signed into law by then President Trump. This, just to give you some perspective, this dwarfs the economic stimulus bill that followed the previous large crisis, the global financial crisis, the so-called American Recovery and Reinvestment Act of 2009, with just quote unquote, 800 billion. So that bill was 3 times as large as the bill following the financial crisis. And it's also bigger than the current legislation that is debated or enacted in terms of public investment in the US, the Build Back Better program, and so on and so forth. So this is a large, huge chunk of money, which is, let alone like the single reason we should care about this and investigate its consequences and repercussions. So the PPP program, part of that bill, was roughly a $1 trillion federal loan guarantee program established in March 2020 to support specifically small and medium-sized enterprises that were hurt by the pandemic. It ran through the Small Business Administration, the SBA, which has, of course, as an administration, a long record of supporting small businesses in the United States economy through various programs, but which has not seen a program this size yet, ever being implemented, and which also, I think, contributed to some of the things that we're going to talk about in the course of this talk. So the PPP loans are essentially low interest loans, meaning 1% interest loans that small businesses can apply for. And the business either applies through a bank or an alternative lender. And in order to be eligible or to be receiving a loan, the business must not be larger than 500 employees and must not have a net worth exceeding $15 million. So we're talking about like medium and smaller companies. And the maximum amount of a loan that you can get is limited to $10 million. And it's also capped in terms of per employee amount at a mark of $100,000. So most of the loans are really, really small loans. And it is because of this that they are so important to supporting the economic infrastructure hit by the crisis. The loans are to be used exclusively for payroll purposes, but also covering mortgage expenses, lease expenses, and some utilities. And here's the interesting point. If firms maintain their staff, there are certain criteria, of course, but by and large, if firms maintain their staff, the loan can be forgiven. So it's essentially converted into a grant. So the firm does not have to repay the loan. And note also that, of course, applying for such a loan required assistance and requires knowledge, sort of institutional knowledge and experience, because the loans were distributed by a qualified financial intermediary system, banks and other lenders that previously had never done such a thing, but then could apply at the SBA in order to be eligible as lenders, which a lot of new lenders did. So it was basically a story of constant expansion, more money, more applications, more lenders. So you can see here that a PPP can be roughly split into 3 phases. And this is also a very important issue. We can talk about it later also in the Q&A if you like. You have essentially a first very short phase that ranges, that covers a 2-week period in early April 2020. And the reason for the period being so short is that all the initial funds allocated to the program were depleted by then. So after 2 weeks, all the money was spent, which is another interesting observation on its own. And within these two weeks, the SBA did more lending than in the previous decade combined. So that is a lot of money channeled through the system very quickly. Of course, not every business had the opportunity to apply in such a short period of time and get some funding, which why legislators extended the deadline and expanded the program. And a second phase kicked in right after the first phase ended, running all through August 2020, so the end of summer. And then the third phase, the final phase, which also coincides with the change in the presidency and the administration from the Trump presidency to the Biden presidency. The third phase started in early January or mid-January this year and ran all the way to late May. So, and now the program is finished. So we have sort of a full set to deal with and to analyze. You see here the total numbers, roughly 12 million loans in the end, roughly $800 billion of the initially allocated amount. So roughly like 90% were allocated or dispersed. And we have almost 5,500 different lenders involved, which is interesting if you think about the US financial system, which is often perceived not only in academia, but also in the wider public outside of the US, even within the US, I think, as a system that is focused on very few financial institutions that we all know of, but the landscape is much broader and deserves further inquiry. So let me just, before I show you our questions, let me just say, so of course, the numbers that I just presented and all the details, they deserve further analysis. And of course, if you implement such a huge program as a policymaker or as an administration, this draws much attention and also much criticism, rightfully so, because we have to see whether funds are allocated to the right businesses, whether they're used for the right purposes, and so on and so forth. So as of now, the PPP has drawn much attention both from the media, but also from academia. And some things that people have pointed to, for instance, were that there had been fraudulent practices going on. So little monitoring, firms, even Congress people receiving loans that actually previously did not exist, some firms or firms that are not in need of a loan, or even like people that are just trying to, sort of scamming the system a little bit, so to say. So the monitoring and the lax terms and conditions have drawn criticism, but also assessing the effectiveness of the PPP. Is it actually doing what it's supposed to be doing, namely keeping people on the payroll, keeping people from becoming unemployed? So those are different questions that are very, very interesting. Yet we think from our perspective, there's another set of two questions that is worth pursuing. So this is what we came up with in our first step of the research project. So as I said, the system of banks and lenders was sort of in place and was the infrastructure through which the PPP was running. So the engine that was driving the PPP, so to say. And it is plausible to assume that those different lenders, 5,500, behave differently. So the first main question that we were interested in is, do bank types matter in the implementation of a program? Can we see clear differences between different bank types and systems of banks? And second, since we are part of a wider project that is focusing on inclusivity and sustainable growth, specifically for poor and marginalized communities in the inner city, a project whose results are going to be presented next year at the Boston Fed, we are specifically interested as well in whether there are differences in PPP lending between poor and non-poor and minority and majority white communities by bank type. So just to give you a brief overview, what are we talking about when we're talking about bank types? So of course, there's the top category, which is top 50 derivatives banks. Those are the big banks, the banks that you all know, Bank of America, JP Morgan, and so on and so forth. We also have, and this is in fact the largest chunk of all banks, of all lenders in our sample and in the country, community banks. So community banks are smaller, they're usually locally owned, and they usually operate on the local level as well. And they resemble more closely the old phrase of quote unquote boring banking. So this 1970s banking, meaning you take on deposits, you hand out loans, and basically that's it. You cash in a little bit on the interest difference. We have also credit unions, which are of course financial cooperatives that are owned and operated by depositor members. And they engage also by and large in conventional lending practices. Sometimes they're workplace related. So American Airlines has an own credit union. Universities have an own credit union. I think Johns Hopkins has an own credit union. Then we have an interesting category, which has drawn our interest, the so-called community deposit finance institutions, community development, that should mean, which are federally certified and are specifically there to assist low-income individuals and communities. So they should be doing their job according to our theory. We have the farm credit system, which is a specific system for the agricultural industry and rural communities. And we have a new phenomenon that is also hotly debated in academia and in the media and in the finance press, that can be summarized by the term Fintech Lenders, so financial technology firms. There is a ton of definitions. I won't bore you with that, but we just say, for right now, we just say there are financial institutions that use new sort of software and communications devices and algorithms to offer to traditional banking services and also directly engage in lending. And we associate the systems, we analyze the systems associated with each bank type. So what do we expect? We expect that there are differences. We expect that the larger banks, large private banks and the fintech firms are to be less inclusive in terms of class and race when we look at the distribution of the PPP loans. And we expect the community banks, the credit unions, the farm credits, and the community development financial institutions to be more inclusive in terms of class and race, based on their business model, based on regulatory practices, based on existing customer relationships, network effects, and ecologies. Of course, all those different expectations could be mediated in theory by policy design, by regulatory practices as well, but also by institutional learning over time, a topic that we touch upon in the next steps of our project. So just very briefly, we got a full sample of all PPP loans. So we're analyzing the full program. We have data on the banks and the lenders. We coded all those 5,500 lenders and assigned them to a category. We analyze neighborhoods essentially. So neighborhoods that are a statistical artifact called AICGS, which is essentially close to a zip code area. The difference between a zip code and a AICGS, the AICGS is also used by other US official entities for statistics. The difference is essentially that zip codes are not as coherent as a AICGS because they historically follow the mail route, and thus a AICGS might be all over different neighborhoods, whereas a zip code, whereas a AICGS is more neatly and tightly coherent and covers a specific geographic unit on a neighborhood level. We do some statistical modeling and we do some descriptive statistics. If you'd like to know more about that, I'm happy to talk about it in the Q&A. So here is basically some of the most important results. First of all, where do banks do business? For that, we calculated a coverage rate. So we have all these 32,000 neighborhoods basically in the United States. And we asked ourselves, based on the classification of banks and lenders, where do these banks lend, or these systems of banks, to be more precise, lend? And you see here that the community banks, again, the largest chunk of all lenders, a couple of thousands, lend in almost every neighborhood in the country. So they have a very dense network widespread network in the economy, and they lend in 94% of all the places that could, in theory, receive a PPP loan. Followed by CDFIs, Fintech lenders, big banks, and smaller private banks that are not community banks. So basically the rest of the top 100 maybe. So starting with Derivatives Bank 51. All these systems lend in almost 3/4 of the country. So this is an interesting finding because there are much fewer CDFIs than big banks and also regional banks and fintech lenders. There's even fewer of those, but they are not geographically bound. You know, they do lending through online applications, so they are detached from sort of having a brick and mortar office present. Whereas the CDFIs they do have. In fact, they need to. And so the CDFIs, there's only relatively few of them, a couple of hundred maybe, 150, 200, but they lend in almost 3/4 of the country, which is an amazing fact. And the credit unions trail behind, and the smallest ones are the farm credit institutions, which makes sense because they're focused on rural areas. If you dive a little bit deeper into the profiles of these banks, you see that we can identify what we call specific lender profiles or lending specificities. Here you see the two variables or the two characteristics that we are most interested in. Again, that's high poverty neighborhoods. That's neighborhoods with the poverty rate above 20%. And it's majority minority neighborhoods. So a neighborhood where the share of the population that identifies as white is below 50%. So very diverse neighborhoods, in other words. And you see here in how many of those neighborhoods specific bank systems did their business. So in other words, how important are those neighborhoods for those different banking systems? And here you see a pretty clear and remarkable trend or a pretty clear profile that both the CDFIs, the community development financial institutions, and the fintech lenders are clearly above the other bank types when it comes to both focusing on poorer neighborhoods and focusing on more diverse neighborhoods. So the CDFIs, for instance, almost do 40% of their lending, of all the PPP lending that they've done, almost 40% went to minority majority neighborhoods. That's a lot because if you imagine the 32,000 neighborhoods in the country, not 40% of them are majority minority. So it's a much fewer percentage. But the CDFIs focus on those neighborhoods. The same with poverty, almost 30%. The fintechs are similarly inclusive in terms of both, although they trail a little bit. And you see the rest is pretty similar with the farm credit institutions trailing, being sort of the last on the list in terms of minority inclusivity. Again, this makes sense because they focus on rural communities and there are just much fewer minority majority communities in the rural areas. So the last finding that I would like to show you is this, and let me zoom in. So these are results from our statistical models. Without going too much into detail, what you see here, so this is focusing on high poverty neighborhoods. It's neighborhoods, again, with more than 20% poverty rate. And you see here on the vertical axis, you see the different bank types. And on the horizontal axis, you see coefficients, and you see the dotted line, the dotted vertical line, which represents 1. And if the coefficient is on the right-hand side of the dotted line, i.e. greater than 1, that means that being a poor neighborhood sort of has a positive effect on the number of loans that a specific bank type makes in your neighborhood. In other words, you are not sort of distracted, or you are not, poverty does not sort of diminish or decrease the likelihood that you make a loan, or the number of loans that you make. And the other way is true for if your coefficient here is on the left-hand side of the axis in the color red. So what you see here is, again, mirroring the descriptive statistics that I just showed you. CDFIs on the very top, followed by fintechs, are the only two subsystems of lenders for which high poverty is not a factor that deters them, is not a factor that decreases the number of loans compared to non-poor neighborhoods. That's not saying that the other banks do not lend in those neighborhoods. It's just saying that the likelihood or the number of loans that you make as a system of banks is higher in non-poor neighborhoods if you are part of the other group of banks and not a CDFI and not a fintech. So if I scroll to the right, you see a similar picture for majority minority. Again, CDFIs and fintechs at the top of the list. The difference is that if you take all banks into account, minority neighborhoods or diverse neighborhoods, by and large, do not seem to be a factor that decreases the number of loans. This can be true for several reasons. We think that regulation is part of it, and CRA requirements and the history of the banking system and the changes that follow from that. Poverty, although, decreases the number of loans. But by and large, the trend is similar. CDFIs and fintechs hold their ground in those neighborhoods. All right, so some surprising findings before we wrap it up. So in keeping up with our expectations, CDFIs are the most inclusive bank type. Surprisingly, and contrary to our initial expectations, community banks, the farm credit system, and credit unions are on the least inclusive, on the end of the least inclusive sort of type of banks, which is interesting and deserves further inquiry. The big banks are inclusive, particularly along racial lines. Again, that might be true because of CRA requirements, but also for other reasons. That's a surprising finding, though. Fintech lenders are also surprisingly inclusive. And as I said, this is a bigger project, and we have a lot of work in progress. We are currently analyzing the timing effects, the three phases of the program. We are analyzing different subsamples of the loans, very small loans, very large loans, different industries. And we are also looking at political factors involved. So let me close by just mentioning the three implications. There's 4 bullet points, but it's 3 implications that also helps maybe spurring the discussion. First of all, so contracting out the PPP process to qualified lenders and lending institutions might be said to be discriminatory and to be reducing inclusivity. The question arises, okay, what might be the alternative? The alternative might be, if we look across the Atlantic from a transatlantic perspective, the alternative might be a system of lenders that is based on or centers around a public bank or different public banks, like the German Sparkassen or the German KfW. So we have seen in the United States that North Dakota has a public bank, state-owned bank, dating back to 1919. That's old-fashioned prairie populism where it emerged from. But also states like New Jersey, the current Governor Murphy just passed an initiative to establish a public bank. Second of all, if we want more resources to flow to firms in poor and majority minority communities, we should increase the capacities of CDFIs and maybe fintech lenders, maybe because there are also some other signs on the fintech side that I haven't mentioned yet. So program design and oversight, and specifically tailoring the program to the needs of those communities would be a policy implication. And finally, streamlining the program with a more focused approach while also creating a new social policy framework might be helpful in the long run. I'm aware that institutions are sticky, but crises always present a new window of opportunity. So think of it as an institutional division of labor. If unemployment insurance is sort of increased and taken out of the PPP framework, you can focus more neatly on supporting the firms and their specific needs, and the labor force does not have to worry whether to become unemployed if a firm does not receive a PPP loan. So you take that motivation out of the equation and guarantee security for the workforce through other mechanisms, like in Germany, for instance, with some programs. But still, you are able to lend to firms that need liquidity. Thank you so much for your attention. If you have further questions, you're also happy, you're invited. I'm happy to answer your emails. You see the address here. Thank you.
Michael, thank you very much for that presentation. Let me ask you one sort of bigger picture question just to get going, because I think it's kind of implied as a focus of your paper, and that is, and I want to maybe put it in a comparative frame. If you're comfortable generalizing a bit from what you've learned about this particular PPP case, what would you say about the way that the U.S. financial system is organized in terms of its ability to generate inclusive economic growth? And particularly wondering, given it to the extent that you're familiar also with the structure of the German banking system, how you would compare the tendency to foster inclusivity in the United States compared to Germany? Big question, but any part of it would be interesting to hear your answer to.
Yeah, that's indeed a big question, but an important and interesting question. Thank you for asking this. So, the level of inclusivity in the U.S. banking, it has always been a hotly debated issue, and we know about the past of redlining. We know about the whole mortgage lending processes and so on and so forth. So this is a thing that policymakers need to address and the wider public needs to address and currently work on. I think there is, so I personally was surprised to see such stark differences in inclusivity. And I think if we focus again on the community development financial institutions, which are few in numbers, but strong in their mission and in their lending, and just to put it into perspective, those are usually community banks or credit unions that get an initial stamp of approval. So that system that many observers are not aware of is a system that is worth fostering and stabilizing. Specifically, if you ask about targeted economic relief measures focusing on marginalized and poor communities. But on the other hand, however, we have also seen that the bigger banks also did a huge chunk of the lending. Yet, when we look closer, we see that they tend to lend to larger firms. They tend to hand out larger loans, and also the institutional knowledge, the prerequisite of applying for a loan, might not be available to smaller businesses in different communities that we are interested in, and thus leaves them out of the equation if you talk about the bigger banks that we all know are the center pillar of the American banking system. So if you compare this to Germany, again, the last point that I made, I think the German system of public banks is a very unique system and is a very strong system. And Mark Cassell is an expert on that. So he might as well chip in. So I remember like in the 2000s, there were a lot of trends saying, Germany, you got to get rid of your public banks. They're inefficient. You're overbanked. Deutsche Bank is sort of the role model. It was an important bank in the past for economic development in Germany. But the savings banks, the Sparkassen, and the KfW, the State Development Bank, they have proven time and time and time again, starting with reunification, the global financial crisis, and now COVID, that they were able to support communities all across the board, whether they're more affluent or wealthy, or whether they're, relatively speaking, poorer. And so I think there's a lot to learn from this for different contexts like the US. And I know that there's talks going on in academia and in the media.
Thanks. I mean, I see actually a kind of irony almost in your conclusions, because on the one hand, if you say that the community-based banks, the most locally grounded banks, were the best at inclusive lending, and that would and in a way that those banks mirror some aspects of the locally grounded banks in Germany, right? But on the other hand, you say that it's the fintechs that were also good at inclusive lending. These are the most footloose, the ones that are the least grounded. anywhere locally, have the least kind of identity in the community, which and is sort of maybe the least like or stereotypically seen as being kind of an American invention, and maybe much less like the standard perception of the standard German financial institution. So, I mean, do the fintechs have this hidden potential to be a force for a fairer U.S. economy, or are there some things about the fintechs, since it's a relatively new phenomenon, that we still need to look at before you could jump to that kind of conclusion?
Definitely, I would say both is true, but it deserves a further attention and inquiry. So the fintechs, they're a moving target. They're kind of a little fuzzy. There is not like even in policy circles, I think people, the same with digitalization, people always talk about it, but what does it actually mean? So that's the same with the fintechs. They are the poster child of the digital economy in terms of finance, and they are to become more and more important. So contrary to our expectations, what we found, as you said, they seem to be really, really inclusive. And from anecdotal accounts, we know that many small businesses got their loan through a fintech, is specifically because you could easily access them, for instance, via your cell phone. Yet, on the other hand, and this is sort of the future outlook of the next steps of our project, the fintechs have also drawn a lot of criticism because a recent study from University of Texas has found that most of the fraudulent practices have occurred with fintech lending, because the incentives for the lenders in the PPP program were not so much actually caring about the business in terms of, is the business able to repay the loan? Can I get a constant flow of interest income that I can generate? It's the lenders were paid off by the SBA with a fee. They just received, based on the amount that they lend, they received a fee, and that was the income. And the fintechs were really strong with that. They generated millions and millions of small, very small loans, generating very, very small fees, but in the end, getting hundreds of millions of dollars out of this program and being very profitable. And if you don't have the incentive to sort of establish long-term lender-borrower relationships, know your customer, screen the customer, know the neighborhood. If it's a family business, you've been in business maybe for 30, 40 years with this business, you know the ups and downs of the business cycle. If you're not interested in that, or if you're not at least incentivized to do so, that opens the door for a lot of fraudulent practices. Not saying that they openly and knowingly did this, but at least there was a lack of a monitoring mechanism that led to all these things. So the fintechs, yes and no, but I would say in the end, if you take the complete package, relationship lending that might also use new technologies, but relationship lending, knowing your customer, being there for the community, is in the long run more beneficial.
Okay, thanks. Let me remind viewers, if you'd like to ask a question, just click on the Q&A tab and you can do it right there. But I have one other question for you, and that's about due diligence, which is, kind of a basic function that a financial institution does when it's looking at prospective customer for a loan. During the PPP program, were due diligence requirements the same as they sort of always have been and are, and whatever the answer to that question is, in reality, did all different types of financial institutions do the same kind of due diligence? In other words, could that have been a factor at all in who lent to whom?
I'm sure that this was a factor. So if you look at the very initial phase of the program, the first 2 weeks actually, when the first pot was all spent, all the borrowers or the firms applying for a loan had to do was to sign off that they are acting in good faith. So there was no checking the books, there was no further screening. Of course, there were on paper some requirements that you had to be in business already for, depending on what type of business you are, for a year or 2 years or even longer, and so on and so forth. But no one was checking. There was no need to certify that you couldn't get funds anywhere else, which has led, for instance, to some listed companies actually getting a loan in the beginning. Companies that had reserves and did not need liquidity getting a loan, and also these kind of fake firms that then popped up. So that was the only kind of sort of acting in good faith, the only kind of control that was in place. And also, if you look at, as I said, the loan can be converted into a grant, essentially, can be forgiven. So that process is still ongoing, but so far the numbers are astonishingly high. So it's very, very few cases. There's no systematic data yet on that, but very few cases have not been able to get loan forgiveness. So I would say the numbers are, I think, like right now, 60% or 70% of all loans, meaning more than 90% of the ones that, 95 that applied for forgiveness, have been forgiven so far. So that's basically free money, right? And this I think can be a problem. Yet, if we look at the changes in the administration, as I alluded to, the third phase of the program with the Biden administration in charge, there were some changes not only on the eligibility side, but also on the sort of screening and monitoring. So right now, the newest version, but this is only applicable for loans after a certain date, states that upon further review up to 3 or 5 years in the future, the SBA and others might be able to check whether the loan was spent accordingly and whether the business was actually really in need of a loan. I don't know how it is going to end up, but at least on paper, the possibility is there that they either then have to repay or pay a fine.
Is that change that the Biden administration has implemented motivated mostly or uniquely by a concern for fairness, or is there some broader, is that part of a broader policy or potential policy evolution in the banking system that the Biden administration is considering?
I think both, but let me spend some time talking about the potential political differences on Capitol Hill. So this is still a thing that we are looking at and deserves further research. But I think there's two things. The first one is, and if you look at the general sort of discourse, Biden presidency, also from an international perspective, but also from a domestic business perspective, the Biden presidency is very closely observed by the digital companies and the financial technology companies. As is it going to be a presidency that tightens the grip in terms of regulation of these companies? And this is yet to be decided, but I think this is in general a topic that the administration is aware of. Secondly, if you look more into the legislative history, not only of the PPP, but also the other programs enacted during COVID, there are some initial signs, and again, we are working on this, that there is a sort of a partisan divide in terms of how favorable is the PPP program viewed through the lens of a Republican or a Democratic legislator. And so there is another program, for instance, that some people or many people might not know about, the so-called EIDL program, EIDL, which is another loan program run through the SBA. But in contrast to the PPP, the application criteria are much stricter, the monitoring is much stricter, and there's no forgiveness. So low interest loans, but they have to be repaid. Much more similar to the German KfW state bank initiated program. And that program, the EIDL program, was much more favorably viewed by the Democratic side of the aisle, whereas the PPP program, especially in the beginning, was a project that not only the Trump administration, but many Republican legislators were pushing for.
And how can you explain that? Is there anything you could say about why that it ended up being a bit partisan that way?
Mark, you want to jump in?
I mean, I think that in the end, a lot of it has to do, I think, with interest group pressure. I mean, the Trump administration, as well as Congress, leaders in Congress, were really pressure to try to get as much money out as quickly as possible. And so I think that initially they latched on to the PPP program and really pushed, really de-emphasized oversight, de-emphasized checks, because they, at least in part, they felt like they were opposed to it ideologically, but I think they also saw it as a slowdown on the process of getting money out. I would just sort of emphasize a couple things that Mishael said. One was that, this is a program really that was one of the largest industrial program that the United States has embarked on since the Great Depression. I mean, it was an enormous industrial policy. And what's interesting for the German, I think for a German audience, is the fact that in Germany, they also used a similar program whereby they essentially put private lenders, or lenders, I should say, private and public lenders, into the role of gatekeeper for this program. So in order to achieve any of these subsidies, you had to go through your local lender. And I think that in itself is sort of interesting, is that we have essentially farmed out or contracted out the oversight, the application, the screening to essentially private financial firms. And Michael and I are really interested in how that matters. What difference does it make? What kind of bank did the loan, or what relationship it has? And in particular, as he said, how does it matter for groups of people that have historically been discriminated against?
And that gets to a question that we've got, which asks, whether it would be more efficient, maybe more equitable if the federal government had a stronger role in all of that.
Mm-hmm. Yeah, I don't want to be the advocate for an ever bigger government here, although in some areas this might be clearly beneficial. But this is a legit question, and a very important question that is not easy to answer, because we know about sort of bureaucratic inefficiencies and so on and so forth, like inner logics and the rest. But I would say in the end, so if you establish, for instance, think of the North Dakota example I mentioned, or think of the maybe future New Jersey example with a public bank. And then you have the public bank on the state level maybe, and then you have the system of lenders on the state level as well that can cooperate with the public bank. So it's not the SBA as a giant bureaucracy that hands out all the money, but it's the public bank. And I think if you set this up similar to the German system, what you get, maybe in the short term, it's not as fast, but once an institution is in place, it can generate sort of spillover effects and other beneficial effects. You get an anchor institution that sort of can both relate to the borrower level, the customer level. Also, maybe private households could apply for a loan to renovate their home and make it more energy efficient, like we do in Germany. But also the firm level. So you have this firm state bank relationship, firm household state bank relationship, but you also have a relationship between the system of private and public lenders on the state level and that state bank that fosters mutual trust. So I think in the long run, that triangle that you could set up could be more efficient and more effective in targeting the money, and not just looking at swiftness and at sort of just ballooning a sort of the budget that is handed out.
Yeah, and that actually also dovetails nicely with another question we have, maybe as an alternative to a larger federal government role, which is strengthening the more community-based banks. For example, the questioner asked, for example, would ask what the supervisory is there a supervisory function in these banks to make sure that the right kind of goals are pursued, and is there a way to make it maybe even more financially interesting to be a community-based bank, with sort of just making that a more important part of the overall landscape, be perhaps an alternative to a stronger federal role?
So I would just say a couple things about the community banks. I mean, I think we should be wary about romanticizing community banks. Community banks are not Sparkassen. Community banks are different from Sparkassen. Community banks are for-profit institutions. And as we know from way back in the 1980s, there were lots of savings and loans that we considered to be community institutions that really went off the rails, in part because they were for-profit institutions. And what we found, at least in our research, was that financial institutions that had a public purpose, a public mission, much the way that Sparkassen have a public mission. Sparkassen, for example, are for-profit institutions, but they have a public mission as part of their overall purpose. And the CDFIs, for example, are sanctioned by the state, and they have to demonstrate a public purpose. And we found that those institutions were far more inclusive, both in terms of race as well as class, than any of the other institutions. And so I just think I would be a little bit wary. And in terms of oversight, again, the United States doesn't have any public banks outside of the Bank of North Dakota. But Sparkassen, for example, have a very, very high degree of oversight. There's a great deal of oversight, and not just for their fiduciary responsibilities and profits, but also for their public purpose. So their division between the supervisory board and the management board is very effective, both in terms of ensuring that the books are straight, but also ensuring that the bank actually serves the constituency that their mission requires them to.
And if you look at other, say, countries at a similar level of economic development to the United States and Germany, can you say that many of them look more like the United States or more like Germany, or are the US and Germany both sort of, I don't want to say outliers, but kind of have particular systems and unto themselves?
So I mean, I don't want to speak for Michael. I mean, I think that what's interesting about Germany and the United States is they both really use banks very heavily. And Germany obviously is a very bank-based system. There are lots of banks in Germany, and banking plays a prominent role in Germany's economic development historically as well as today. And other countries like, for example, France or England, France in particular, was much more state-centric. The state and businesses had to form relations before they went to the bank. Banks, by and large, are much larger. They're much more centralized. You have a lot fewer of them. They tend to be a lot bigger. And so, I think what's interesting about both the United States and Germany as a comparison is, again, this relationship between the banks and their communities. That's what we're talking about here. We're arguing that we're just relying on banks as if they were sort of these automaton market actors, and they will just implement the policy without any direction really is a fallacy. That the effectiveness of banks and the bank systems relies on the fact that they have different relationships with the communities that they're designed to serve. And that's what we're finding both in the United States, and I suspect that's what we will find as we do our research further in Germany.
Yeah, so let me just briefly add. So many European countries, including France, Spain, Italy, used to resemble, notwithstanding the fact that Mark mentioned the state involvement, but in general used to resemble much more the German model. But during the 1990s, a lot of these states have privatized or partially privatized their formerly public banking system, the savings banks, or building societies in the UK. And that was the zeitgeist back then. But what we see, again, in times of crises, we get back to square one, and these seemingly old-fashioned overbanked systems are the systems that are, not only because of that, Germany's also, I mean, economically in a different position, but definitely this contributes to the resiliency of the economic system of Germany and the system of lending and liquidity provision. So we have seen a trend towards more the US market-based system, but now we might see a new form of reversal, because also on the EU level, the establishment of public banks is on the map, and many countries establish the KfW counterpart or the Bank of North Dakota counterpart in Europe in order to access recovery funds, for instance.
We have a question which asks sort of where we are, where you are in your research in terms of getting a kind of, some recommendations, policy relevant recommendations out there. Like, are you already a point where you can say, we feel pretty, strongly that A, B, and C is the right way to go, and what are those, or if not, when do you think you'll have those kinds of recommendations?
I mean, some might even say we had the recommendations for years, and they just proven to be, proven to be partially at least justified and proven right. But no, just kidding. So the project will take us way into 2022, and then I think we'll have a really, really good overview of all the political, economic, and also comparative factors. But if the results hold true, I think the bottom line is strengthening not only the localism of banking, but also the mission, as Mark has alluded to, because this is so if we rely solely on market mechanisms, we know from political economy that there are inherent inequalities and inefficiencies also in markets. I mean, there's a whole stream in economic research that just deals with that. And if you come up with a political mission and a more social perspective, a civic perspective, that might help to alleviate those inefficiencies or prevent them from becoming inefficiencies, because you can really tackle that issue and direct the flow of money where it needs to go. So strengthening the mission-based approach to finance, maybe making it more attractive for credit unions and community banks and other banks to become CDFIs, to look at this. And also establishing, again, on a wider level, maybe a public bank for infrastructure purposes and similar purposes. And also, as a final point, maybe, I think I mentioned the phrase new social policy or new policy framework. So again, if you compare it to Germany, for instance, in Germany, I mean, not everything is perfect, far from perfect in Germany, but we do transatlantic research. So there might be mutual learning. So we have this instrument called Kurzarbeitergeld, which is an employment retention scheme, a short-term work. And this has served for decades, not only in times of crises, but also in times of supply side or demand side drops in the automotive industry, for instance, in the mining and industry, in the heavy industry sector for decades, as an effective instrument to prevent people from being laid off. And if you put that out of the package that the PPP was supposed to serve, I would say you could focus more specifically on making the right loan to the right business in order to support business and the expenses and the mortgage payments and whatnot, and paying sort of the business paying their bills vis-a-vis other businesses and suppliers. And you mitigate the pressure on the workforce, and you might just cut this out and put it into a social policy framework and not including it into a financial market-based, lending-based sort of policy instrument.
Well, you actually just assumed part of the moderator role, because that was going to be my last question about Kurzarbeit and the short-time work. And so it sounds like you're saying pretty clearly that one of the lessons, at least intermediate lessons you can draw, is that having this guaranteed retention of employment as part of the broader PPP program is maybe not the most efficient way to do it, and better to separate that out the way Germany does, and not include it, and have it more as a kind of, it sounds to me like what you're saying, an ongoing program, but separate it out from the broader financial lending, right?
Yeah.
Okay.
Exactly.
Very good. Well, on that, I think important and helpful comparative note, let me thank you, Michael, for joining us. While we hope that we won't anytime soon have the kind of economic crisis we had last year, nonetheless, as you just said, there's some lessons from your research for even more normal economic times, and let's hope that policymakers both here and in Germany continue to watch for your research and your results. Let me also thank all the viewers for joining, and then just lastly to wish you all a good morning and afternoon. So bye-bye.
Thank you so much. Bye-bye.